Hello and welcome to today's free trading video and market analysis. I'm your host, Kenny, Senior Research Analyst with the MiniAnalyst.com. The first thing we're going to look at here is a chart of the market. This is the mini S&P 500 futures contract, front month in nature, looking at last print of 1207. Of course, this is the December contract. And what's interesting about this Friday, in late September, 16th day of September 2011, falls about another week away. Wonderful. Is that we've got some kind of mixed dynamics. We had a pretty nasty sell-off as the market tried. We're going to look at some interesting things on a daily chart. Very interesting. Traders are definitely, discretionary traders are definitely essentially controlling this market. That's why you see essentially or that's why you see extreme directional moves that for us actually today have not been particularly great. As you can see, generally the market, we had this gap open, slight gap open. We had this surge to new highs, put in a double top, and then boom, there's the discretionary traders. Oh, a double top. Let's take the market all the way back down almost to 1195. Hope you guys can see that. I hope the screen's big enough. But what was interesting is this level didn't hold our key measure of trend, as you can see in this not even sure what color that is. Kind of a peach color. I'm not sorry, I can't describe that color. It's been with us for many years. Nevertheless, the market was supposed to hold that level, but really just wanted to come on down and break the level and actually turn all of our proprietary indicators. These are our indicators that we use to gauge where the market's likely to go, our intraday dynamics as we refer to them. Anybody who's watched this video before certainly is well aware of our intraday dynamics. What was interesting is we had full all-out bullishness. Look at yesterday. Look at Thursday's session. Full all-out bullishness, and lo and behold, you get the little hold. You get a little bit of dip in the toe in the cold water. That's too cold. Let's go back to the upside. Beautiful trading day yesterday. Made some good money yesterday. And as you can see, when we have a congruency of all of our indications, accelerating bullishness in all these indications, you're definitely going to get, or more than likely going to get, a higher market, particularly on the bullish side. The same goes for the converse, which if you see all red and particularly accelerating to the downside, you're going to get a close likely at the lower echelon of the day's trading range. Today, what's interesting is we again tried to, it was almost a bull trap, and essentially we're right back near the open around 1207 in the ES contract, very near the open there. You can see it right there. We'll call it 1205 as the market again double top, bull trap, comes all the way down, puts in a double bottom, and then reclaims the trend. What's interesting is right now we are essentially flat, bearish there, flat. So really it's kind of any man's game on this late or this Friday, late day in the week. It's kind of any man's game. We would definitely be looking at the short side just a couple hours ago. It's about 12:30 Eastern Standard Time, Eastern Daylight Savings Times actually. But as far as a free informational day trade, we really just can't issue a trade today on the market, given that we have such a choppy market. I mean, that's really the bottom line. Is we have a choppy market. You see a bull trap, you see a double top, you see a break of the trend, but yet a double bottom, and then back in the middle of the range. So it's really kind of a dangerous environment to be a discretionary trader. So really no informational day trades today. We are above the high of yesterday. So that is a bullish indication. We're holding actually bearish on the market. We're going to look at that in a second. We're holding actually bearish on the market. There we go. Because, look at this. For our intents and purposes, this blue line here is exactly what we trade from. There you see we got right up to the underside of it earlier, a couple of weeks ago, and we're right back there. So a beautiful selling opportunity. Particularly that's why you got that sell-off at 12:15 in the futures. We're looking at about 12:20. In the 12:17.58 is the key level in the cash. We're now at 12:14.55. Again, I hope you guys can see that. But for our intents and purposes, we are 80% bullish on the market. Official market timing is bearish. Bearish for both those statements. And as you can see, intermediate term, the momentum is bearish. This should actually read neutral in terms of directional movement. We have intermediate term neutrality and arguably a short term neutrality in directional movement. So it's kind of interesting. We did, of course, have this take our short profits signal right here, and the market has essentially found a bottom since then. But what's even more interesting is not only are we having another beautiful retest of the of our key intermediate measure of trend following support resistance, but you see this beautiful triangle formation that we had mentioned. There's all kinds of different discretionary patterns going on as the players, as soon as we had this technical breakdown, the whole world came in and started trading the U.S. stock market. And so what's interesting is everyone's keying off of these patterns, these traditional patterns, as we have a beautiful H&S setup, head and shoulders. There's your right shoulder. We came back down to retest the upside, the ascending triangle, and came back down. We knew, we'd mentioned our clients, we're definitely going to have an explosive move because we are right in the thick of things right here. So, and of course, we get the explosive move higher. It's about 55 points out of that range off the 1160 level, and now we're right back at resistance. So definitely holding our bearish bias, even though we've seen some pretty impressive buying in the markets. I mean, we've seen some really strong buying in short little spurts, suggesting that the market was going to go higher. That's been over the last few days. But even though, I mean, this is a beautiful selling opportunity. Arguably, this is a discretionary selling opportunity. Go ahead and put some short exposure, take some profits on the long side if you bought the bottom around here at any point. But definitely bearish as we are above this key level. We'll call it 1230. Above 1230 in the cash, we're at 1215, so another 15 points higher. Either way, futures or cash. Actually, we can't even really say that. We could get an outside move because this measure, we don't really trade from it. A lot of players do. We don't really let it affect our. We're always aware of it, and so 1250, so 1240 to 1250, we get an outside shot to retest this high, but we have a monstrous level of resistance. So 1/3 short exposure here. Take another third there. And maybe another third at so 1240, 1250, another third at 1260, and certainly you'd have a stop at 1280. Beautiful trade, intermediate term. That'll be a free informational intermediate term trade off the daily chart. Definitely a short opportunity, but let's go ahead and look over and see. Finally got out of that MRSEM short position. That was a pretty nasty loss. We'll go ahead and pull that up and see what that looks like. It hasn't changed our maximum drawdown. 13.9 was always our max drawdown on this portfolio. $644 average trade net profit. Now that is absolutely insane. This, of course, after slippage and commissions. But there you see it. Boom. What did we mention? This was a beautiful time to get involved. I mean, this thing was just going parabolic. Beautiful time to get involved after that drawdown. And as you can see, we're right back in. If you look at the detailed version, we're right back into a nice bounce back that you've seen right there, and go ahead and minimize that. So we went long about 30, now at 63, so a $3,500 gain. Not too bad. Not too bad at all for the MRSEM. What do we look at? Here's our free trading model, I believe. Yeah. So you guys can trade this free. Still, anybody can get into it. This is actually trading the Russell contract. $130,000 profit. $12,400 was the maximum drawdown over 8 years. So you're looking at about $15,000 a year maximum drawdown, matching essentially what you put in. Now, of course, you got to have more margin. So let's say you're gonna. So obviously, margin on this is gonna be about 20 grand. So you're gonna need 35,000 essentially, roughly. Maximum drawdown, we're saying about 15,000. So let's just say that 20,000 margin, if you've got it in T-bills, certainly, which you can even get interest that way. Although these days, obviously, you're not getting much interest. So either way, about $35,000 you'll need to put in to get involved in this model. And what's more, you don't have to put in 5 contracts. If you want to make $127,000 after slippage and commission over the last 8 years or so. But again, a free trading model. If you have any interest in that, again, $4,000 average trade net profit, absolutely insane. Usually over $100 is pretty daggone good, and we've got about $4,000 there, so pretty impressive, particularly for a free model. And haven't really got any trades lately. We did want to look at the equity put call ratio and the VIX, and definitely the VIX is moving lower, so that's good for the bulls. How high did we get on this latest move? 95 or so. We finally got our measure over 1, our close over 1 on this day, so that was pretty nice, and that was in the TF contract, 75.50. So that's a pretty nice 55-point move or so. Not bad, not bad. Of course, that was just a discretionary trade we'd been mentioning to you, and wasn't really part of this system. So moving on, we're going to go ahead and I guess minimize that. Keep on rolling. Got a here's the Evo. What's interesting is we can go ahead and pull this up. This was what I was talking about. This was painful this morning. Beautiful trades in the Evo recently. Beautiful trades in the Evo, particularly yesterday. We're looking at the new derivation of the Evo MCM. You're really going to like the Evo MCM. Nevertheless, really painful to get stopped out just less than a point below the lows. But again, point off the lows, got stopped out of the Evo. Pretty nasty, pretty unfortunate, pretty painful. Nevertheless, essentially at a new equity high, as you can see from the equity curve. $30,000, $5,000 maximum drawdown, just one lot, $124 average trade net profit after slippage commission. Very nice trading model. What's more impressive is the MCM. $102,000. Your drawdown essentially doubles. Your profit triples. You're trading up to 5 contracts here, so intraday margin of $2,500. So about a $15,000 portfolio, you could trade this $2,500 margin and have $12,784 a drawdown. Roughly, and that's historical over the last 5 years. Over 5 years, there's your graph breaking out nicely to new highs. And there you have it right there. Look at the money that was made yesterday. This was beautiful yesterday. Bought at 703.50, bought again at 703.50, bought again at 704, 703.20, and then bought again at 705.70, and rolled all those all the way up to about 710. So about, I think it was about $2,500 it made yesterday, or $2,000 after this loss. $2,500 on that trade. Beautiful trade in the new derivation of the Evo MCM. And of course, that's going to be added to our portfolios. We have a lot of new trading models, a lot of things to talk about. Again, we've been in business for over 8 years. Each year, you have to remain on the cutting edge. We have models that we developed years ago that are still trading today in our portfolios. We have models that we developed years ago that aren't trading, that may last only a year or two. So we're in constant development to remain on the cutting edge of the trading models. Of course, non-optimized, non-curve fitted, always, and of course, including slippage and commission, deducting slippage and commission, and you can see these models that we have continue to make money. Look at that beautiful money yesterday. We wanted to look at maybe the Evo EM Active. Let's see how that's doing. Not too bad, not too bad. $40,000, $5,000 maximum drawdown was that Evo EM. $62,000. Did that see that just got quickly stopped out today? Boy, that's painful to see the market coming back up, particularly given the exposure that we did have in the Evo TF this AM, and of course the market is bouncing back to the upside. You rarely want to see that. Nevertheless, the Evo ES and the Evo EM both quickly getting out of their way, but we're going to keep on moving on. These are a couple things we wanted to talk about. We're going to look at we haven't even gotten to our portfolios. 13 minutes into the video, haven't even gotten to our portfolios, just still talking about new trading models. And we have more new trading models to talk about. Again, non-optimized, non-curve fitted, that have been running live unchanged for years and years. These are not one of them. The ESM 30 has been around for about 6 months, and as you can see, continues to put up beautiful gains. We're looking at, I believe this is A, B, and C. So we're going to look at A first. We're going to pull that up. And that's had a nasty drawdown lately, as we've mentioned. Nasty drawdown. So where are we looking at? I don't know if you guys can see that. $24,000 was the maximum drawdown. $275,000 over the last 9 years. Again, I hope that's big enough. Maybe this will be bigger. That's always nicer. There we go. Not quite as dark. $275,000 maximum drawdown. $25,000. That's the account size required. So you're going to put in $27,000, let's say, and you're going to make $27,000. Actually, this is 9 years, so you're going to make about $30,000 a year after slippage and commissions. Average trade net profit $141. That's a very impressive model, and as you can see, still making impressive gains. And what's more is we've just experienced a nasty drawdown in this portfolio, so you already see the tick higher. weathered the storm. And so that's the then we're going to look at this model. This is the C version, $371,000. Your drawdown just goes up less than $10,000, maybe $8,000. So you're going to put in 50. Actually, this trades 16 contracts. So this is going to be a $100,000 portfolio. 16 contracts you're going to have in this trading model, and it's actually a swing model. So essentially, you're going to have margin of, almost $100,000. So let's say the margin there is 50. So yeah, you're going to have essentially $100,000. I think you could get by with it, particularly given that we've just experienced most of that the lion's share of that drawdown. Actually, we're going to look at the performance graphs. Look at that. Prior to that, we had some kind of blips, but definitely a beautiful trading model. Again, non-optimized, non-curve fitted. $32,000 maximum drawdown, $190 per trade net profit. What did I want to say about this trading model? Oh, 9 years, so you're going to be making $40,000 a year at least, if not upwards of 50. Well, you take 37 and divide it by that, so obviously 30, yeah, just over $40,000 you're going to be making every year after slippage and commissions, but you're putting up $100,000, and that's 40% profit over 9 years, 40% annual, and that's not even compounded. You make 40%, you make $40,000. After a couple of years, you've got almost $100,000. You can purchase another unit, so you can actually compound your gains. So obviously, you would be making after 9 years certainly more. What's more is that's your compounded version. This is a static, non-dynamic version, trading the same amount of lots up to 16, and what's interesting is you're also going to participate, particularly with taxes going up. Very favorable tax scenarios. Consult with your certified public accountant, but you're looking at long-term capital gains tax rate on essentially 60% of your profits. So that's a pretty impressive savings just by trading this over, let's say, trading another vehicle. This is the B version. This is probably the most conservative, but what's most interesting and favorable about this is look at this equity curve. The other two had dipped down and were just hooking back up. This one dipped down less, and not only is hooked up, but is blasted to a new equity curve. So this is definitely our preferable model at the current, because you have the least amount of drawdown. $23,000 account size required. You're trading half the size, so 8 contracts, so $40,000 in margin. So about $50,000 you can trade this portfolio and make, again, about $30,000 with risking about essentially this much each year. And that's not even each year. That's one drawdown, and then one drawdown back in 07. That was pretty much everything else. If you take out those, your average drawdown is going to be considerably less. So an absolutely amazing trading vehicle, ESM 30 XX version B. So if you can remember all that, you can write in and you can get involved. Find out how you can get involved in that trading model. Boy, we're really going over today. So I'm going to go back and look at, there's another EVR 3. This is a new awesome trading vehicle. Look at this. $76,000, trades 3 contracts, just a $5,000 drawdown. For the EVR 3, $5,000 is a day trade only model, so you're only looking at $1,500 in margin. So you could trade this with under $10,000. We're looking at the performance graphs. Look at that, beautiful. That's going back 10 years, folks. That's non-optimized, non-curve fitted. After slippage and commissions of $20 every round turn, that's a pretty impressive model. This model has been ongoing. Or at least this is a derivation of a few other models. These models have been ongoing for at least 5 years. This is a derivation of a few other models, and as you can see, absolutely beautiful trading model. So we're quickly running out of time, so we definitely need to switch this and hope this doesn't go down to a blank screen. There we go. So here's what's beautiful. How have we been doing? How's our portfolios? Well, here we go. So you have the MSA UDT as of the middle of September. 325% has been the return. Oh, MAPDT dipped just back below. MAPDT had actually eclipsed 300% for the last 166 days, and under 200 days. It's just absolutely amazing the gains that we've managed to put up. Yesterday was a beautiful day. The leader was QTrader, who's certainly been lagging. MAPDT there with a 13.7% gain. Lost some money on Wednesday. Again, QTrader putting up some impressive gains, and lost a little bit on Tuesday. Kind of a mixed day. Again, QTrader on Monday, and QTrader and Master been tearing it up this week. 15% for the Master, 30% on Monday. Friday was a little not too bad. Pretty impressive day. Last Wednesday, beautiful day, and the day prior. Look at the Master up 47% the day prior to that. So that's how our portfolios have been doing in real time live. But we wanted to talk about a few other things. We don't have much time left at all. I don't even know if this is going to be able to come through, but we're going to have. Let's go ahead and widen this out a little bit. These are some new trading models that we're going to be offering on our website. This is going to be a reserve line portfolio models, and you can actually get involved with this. The price is going to be per contract at $150 per contract. So you're looking at this model will be $450, and what's more, it's only going to be a month. So $450 a month. If you subscribe to a quarter, you're going to save about 10%. If you subscribe to a year, you're going to save 20%. But they're going to be offered on a monthly basis. $450 for this model, $110,000 versus a $3,880 profit over the last 8 years, almost 9 years. Now this is a $10,000 trading model. This is a $10,000 trading model. Trades 3 contracts, $450 a month. $450 a month. This is. Let me show you just what it made last month. $9,000 just last month. Now these systems have been ongoing again for years. $9,000. This is after slippage and commissions. The slippage and commissions. Well, actually, you can see right there. $21,000 has been deducted from this number for slippage. Over $10,000 for commissions. Beautiful. Average trade net profit $120. You can get involved in this portfolio. It's going to be a new reserve line that we're going to be offering. $150 per contract a month. There's 3. That's a $10,000 portfolio. Here's a $15,000 portfolio. 4 contracts right there. So $600 a month for this model. You'll save $60. If you do a quarter, probably about $1,500 per quarter. $267 is what it made last month. Not bad. $7,000. Not bad. Look at this. This is insane. Lost $280 in July. Look at this. Almost roughly $15,000 in the last few months. Isn't that nice when the long side of your portfolio, your 401k, is taking a beating? This is a $15,000 portfolio. If I didn't say that, I believe it's a $15,000 portfolio. We haven't got this up on the website. In fact, you're the first to hear about it. So if you have any interest in the reserve line of portfolios, go ahead and write in look at this. Look at what's been deducted from this figure. $61,000 slippage, $30,000. This uses $25 or $30 per round turn, just like we do. I think we use 20. This uses 25 or 30. Actually, about $25 a round turn has been deducted from this 40. Look at this drawdown, $4,890. Here's your equity curve. Look at that. Beautiful. Absolutely beautiful equity curve. Look at that, breaking out to new highs. Well, there you see. Actually, this model right here, whoops. This model right here, look at what it made. $9,000. It bested. This is a $10,000 model. I believe this is a $20,000 model. We'll have to really figure that out. It's only a $5,000 drawdown. This is a $15,000 model. And here's a $50,000 model. Again, all day trade exposure trades 20 contracts. 20 contracts. So it's a $10,000 margin. You can trade it with $50,000. Essentially, you could trade it. You take that, add in your margin. You're looking at $28,000. But it is a $50,000 recommended minimum for this portfolio. Look at the deduction. It's over $1 million over the last 8 years. This portfolio is made. These are a reserve line of portfolios that are absolutely insane. These have never been offered. These have been going for years and years, and they've never been offered to the general public before. So, if you're interested in these models, $50,000 model, obviously this will cost you over $2,000, about $3,000 a month for this trading model, over $1 million. Let's see what it made last month. $29,000. Unbelievable. And it was $3,000 in fees. 29,000. That's a $50,000 portfolio. Again, you're the first to hear about it. If you have any questions, go to the website, chat with support team live, or shoot us an email to admin@MiniAnalyst.com. Hope you enjoyed this rather lengthy video, and we will see you next time.